Hello, everyone. This is Dr. Gregory, and this is ACC4620, Auditing and Assurance 2. As we did in Module 5, here in Module 6, we're going to start reviewing the process of different account balances and account classifications. In Parts 1 and 2, we're going to be looking at the auditing of cash and marketable securities, and we're going to just touch on complex financial instruments. So when we look at cash, we usually look at cash and cash equivalents. We will have our normal cash account. We will sometimes, most companies have them, have what we call a petty cash account, which is a actual cash that is held by a custodian within the company, and it's used to make small reimbursements to employees. So, for example, the employee has to go out and get something, maybe a repair tool, and it's under a threshold of, say, $500. They get authorization to do it. They're given the money, and then they come back and exchange whatever is left with a copy of the receipt. Or sometimes somebody needs to take a client out to lunch, and so they will go take the client out to lunch, pay them in cash, come back with the lunch receipt, and petty cash reimburses them. And then when the petty cash gets close to being depleted, the custodian employee will go through a process of attaching all of those receipts to a request for reimbursement. That request for reimbursement will go through their accounts payable department. They will receive a check back. They will take that check, take it to the bank, exchange it for cash, and come back and continue the process. We also have cash equivalents, and those are what we consider to be highly liquid assets. They usually are the second, or they are sometimes combined in the cash account. You may see cash and cash equivalents, which would encompass all of this, or you may see cash and then cash equivalents, which is the second asset that can be highly liquidated for cash. And that's usually CDs, the savings accounts, maybe some small money market accounts. Then we have another account called marketable securities, and those are securities that have a maturity date of greater than 3 months, or they have changes in values. And most of the time, or all of the time, they are measured, depending on what they are, at fair value. So if they're less than 3 months, they're usually put up into the cash equivalents. So the difference between cash equivalents and marketable securities is the time they're being held. Now, throughout this course, we have been looking at management's assertions, and we're going to look at management's assertions now on cash. So we want to ensure that the cash exists and that it's in the balance sheet on the balance sheet date. It should be your very first account in the asset side of your balance sheet. We want to ensure that all the transactions included during that period, be it a quarter, month, fiscal period, are complete. You aren't missing anything. We want to be sure that the company has title to all cash accounts as of the balance sheet date. We want to make sure that all the cash accounts reflect the correct value within those accounts. And we want to make sure that cash is properly classified as cash, cash equivalents, and disclosed in the financial statement notes. Now, we can also include cash as being restricted cash versus unrestricted cash. Restricted cash could be cash that is being held for a specific use. It might even be in a separate cash account. There are lots of risks and fraud risks and control risks regarding cash, because cash is the most highly liquid of all assets. So inherently, it's going to be subject to theft. Cash has a high volume of transactions. Again, highly liquid asset. It has an ease to which there are transfers or electronic transfers, ACH wire transfers and such, that can be performed with that cash account. And sometimes cash is tied to bank covenants. For example, you have a bank loan, or the client has a bank loan, and in that bank loan, they must have some type of funds set aside in the form of cash. Perhaps at the end of every month, there must be a minimum of 5% of all cash must be sitting in that account. Tons of fraud risks. This is one that has as many fraud risks as you could think of. If there's more access to cash, there's more risk of theft. If there is more cash available, there's risk to theft. And we may be needing to look at those who have access or are custodians of cash, who may have pressure or motivations to misrepresent cash or steal it. And finally, we look at those control risks. We probably want to do a walkthrough and observe how cash is being operated in the company. For example, observing the reconciliation of petty cash. And we'll want to do some inquiry. We also want to look at what are the policies and procedures for safeguarding this asset, for monitoring the asset, performing oversight. Is there a supervisor that's doing surprise cash checks on petty cash? Is there a segregation of duties issue that we may be concerned about? Are we performing timely reconciliations based on those processes and procedures of those accounts? What is the tone at the top regarding management and board of directors and oversight of the cash account? And finally, I'm adding one because it has come up in audits before, is company authorizations at financial institutions. If you look at some of the best cash frauds out there, and one of them happened to be the city of Dixon, Illinois, Rita Crundwell created and moved cash into bank accounts that she created that the city was unaware of. So what are the company authorizations regarding checks for cash at financial institutions, setting up and have access rights to bank accounts on behalf of the company? When it comes to performing analytical procedures, cash isn't very reliable in that. It fluctuates. It fluctuates because of what's being sold, when it's being sold, what products and services may be sold year to year. So looking at trend analysis is not going to be all that effective, especially horizontal trends. You might be able to do some vertical trend if you're looking at the composition of how much cash you have to total assets. And sometimes companies want to have just enough cash in the account to total assets. And then maybe what they want to do is set aside other amounts of cash for perhaps investments of fixed assets or securities. You can use some ratio analysis in there, but it might be better to compare those ratios to industry benchmarks instead of to past history of the company because of those fluctuations in cash. So it may not be reliable to look at year one compared to year 2, because there may be other things going on in year 1 that year 2 may not be a firm relationship with. But you might be able to use industry benchmarks. You can perform budget to actual comparisons. Look at what the budget was set up, and then look at the actual and see if the expectation of cash in management's eyes when they set up the budget is coming to fruition. And we do want to ensure that when we're performing our procedures, that we make sure that in that analytical procedure, we are cognizant of debt covenants that are monitored and are in compliance. So if you're looking at, for example, your quicker asset test ratio, and you have asset test ratio assets against current liabilities, cash, marketable securities, etc., less inventory, that you're aware that while that ratio may be there to offset debt or obligations, short-term obligations for a company, that some of that cash may be tied up in covenants and is really not accessed. So if you want to be sure that you're covering your ratios correctly, you might want to look at taking your cash account, deducting the debt covenant obligation, and then performing your ratio analysis. Cash has expected relationships and unexpected relationships. The expected relationships that management is going to confirm and you're going to test is that cash really should have no unusual transactions. Every transaction for cash must have a rationale behind it. And if you look and see unusually large cash transactions, such as checks written out to cash, you do want to investigate those. We want to take a look at how cash from operations relates and is consistent with the expectations from sales or net income, and is not significant from prior years. Now, prior years, all things being equal, and we know that year to year, all things are not always equal. So operations based on budget performance should be consistent with the expectations of sales and net income over the actuals. And make sure that in cash and marketable securities, investment income, the cash we receive from the investments that we have with our company, is consistent with our expectations. So if we have expectations that they are going to earn so much in income and cash payments from those investments, that we're seeing that. Now, again, all things being equal, if we have declines in market value, we're going to see those declines in the investment income unless it's guaranteed. So all things being equal, you should see investment income consistent with the investment expectations as far as what they think they're going to earn in cash from that investment. Some unusual relationships that really do need research into is if profits are remaining the same or higher, but cash flow declines. There may be an explanation for that. For example, we may have obsolescence in certain inventory items, and we're discounting those, which results in a cash flow decline. We may see unusual reductions in accounts receivable or the timing of collections. Do we have lagging AR? Do we have AR that is pushing further and further and further out? Are there unusual reductions in AR? Are we getting an unusual number of credit memos coming through? We have declines in petty cash account or higher than expected activity. That's why petty cash is so important to have surprise audits and reconciliations. You can reconcile that at any point in time. Cash plus unreimbursed receipts should match your petty cash. But if we're starting to see declines or unusual requests for reimbursement, you might want to take a look at that. It might be something is going on, or it could be that the organization is evolving in its use of petty cash and you want to increase the petty cash limit. However, if you start getting requests for arbitrary increases in petty cash, you certainly want to look into that and find out the rationale as to why those increases are being requested. Also consider the client when developing your tests. Is it a new client? You'll probably have more substantive tests in cash. Do you have an existing client who has prior audit issues? They may not have risen to the point of material weakness, but there's something to be on the watch for. Clients who are not publicly traded, where you have no SEC reporting and you have very little information out there on that client. Maybe you have an IPO client where you may be looking at the cash that they're bringing in order to see if they're going to go and become publicly traded. Clients with new or closed business segments, that's going to change the fluctuation of cash. If they're new business segments, they may be slow to start or they may have been very popular. Closed business segments, you may see a reduction of cash going on. Clients with changes in senior management or the board of directors, that may change the mission, vision, and goals of the company. They may be getting into more types of debt, which could affect covenants regarding cash. And clients who are in the news, always do a media search or a review search on a client to see, are there a lot of refunds? Are there recalls of products where we could see a reduction in cash or unusual transactions regarding cash because of that? So always remember, the higher the risk of something bad occurring, the more evidence we want to place on the tests. Quick summary. We identified what cash was. We looked at management's assertions. We looked at the inherent fraud and control risks regarding cash. We looked at the fact that analytical procedures may not be so useful when it comes to looking at cash. We want to look at the expected as well as what could be unexpected in the relationships of cash to other activities going on in the business. And finally, what is the relationship of your client to risks? Be sure to read all of the chapter. There's great examples in there. Reach out to me if you have questions, and I'll see you in the class.